Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Sprouts stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 8.4 billion market cap. They're trading at $84 a share and they have 100 million shares outstanding. Sprouts Farmers Market retails fresh, natural, and organic food in the US. It offers perishable items including fresh produce, meat, seafood, deli, bakery, floral, and dairy. They also sell non-perishable products like grocery, vitamins, bulk items, frozen foods, beer, wine, and body care. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Really steady free cash flow, around $250 to $270 million a year. Their free cash flow margin is 4% every year. Net income is a profit or loss on the income statement. It's revenue minus expenses. That's also pretty steady, around 260, 280 million in that area. Also really steady margins. They converted 4% of their revenue into net profit. Revenue is a sales for the company, and that goes up from 6.1 billion to 7 billion. We estimated 4 years of future free cash flows. We also estimated the terminal value, it's all cash flows past year 4, that's 9.2 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $8.2 billion. We divide that by 100 million shares. And we get a calculated stock price of $82. They're trading at $84, so they're trading at a 3% premium. It's a sell according to the model. The only way I could justify an $80 stock price is if their free cash flow grows quite a bit. Not major growth, but they've been really steady the past few years. They need to up that a little bit. There are 12 companies in the same industry as SFM. And if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend $230 million in CapEx. These are the investments in property, plant, and equipment. When they open up a new store, they have to spend in CapEx. And then that dollar amount is carried on the balance sheet and depreciated over its useful life. So when you hear the term capitalized, the definition of capitalize is placing a dollar amount on a balance sheet and then depreciating that dollar amount over several years onto the income statement. Pretty good debt to equity ratio, 1.4. For every dollar of equity, they have $1.40 of debt. They do not pay a dividend. Probably a smart move until they can start generating more free cash flow. Their free cash flow is worse than the average, a lot worse than the Brazilian company below them, Sendas. They rank third in market cap, 8.4 billion, but they look overvalued according to their price multiples. Why are people paying so much money for the stock? Because they think the growth will be significant in the future. If investors thought a company will not grow much, it will have minimal growth in the future, then they'd be trading at a 9 PE. But when they trade at a 28 PE, investors think the growth is going to be pretty big. Only time will tell if that is true. They're trading at 30 times free cash flow. Second worst on this list, 1.2 times revenue, the worst on this list. They generate the least amount of revenue relative to their market cap, but they rank fourth in dollar terms. And their 5-year annual revenue growth rate is okay at 6%. If you put $10,000 into this company 10 years ago, you'd be really unhappy for about 8.5 years. But recently, the stock has done great. Your $10,000 will be $25,000, a 10% annual return. If you invested in the stock at the bottom around 2020, 2021, you could have put $5,000 and grew that 400% to $25,000 in just a few years. Let's take a look at their income statement. This is the first quarter of 23, the first quarter of 24. Revenue is up 1.7 billion to almost 1.9 billion. Let's see if they give a breakdown of the revenue. The only breakdown they give is between perishable and non-perishable, and it's up in both categories. A little under 1.1 billion in perishables, a little over 800 million in non-perishables. So perishables is going down as a percent. It's now 57% of their revenue. It was 58%. Perishable includes meat, produce, seafood, deli, bakery, floral, dairy. Non-perishable includes grocery, vitamins, bulk items, frozen foods, beer, and wine. Revenue went up 9% when you compare 1Q23 to 1Q24. And the increase was due to new stores opened and a 4% increase in comparable store sales. They don't mention how many new stores opened in the first quarter. They do say from 2021 through 3/31/2024, we opened 49 new stores and remodeled 1 store. In February 2023, the board of directors approved closing 11 stores, and all were closed in 2023. Once again, I don't know how many stores were closed in the first quarter. They did complete their acquisition of Ronald Cohn Inc. That entity owned 2 Sprouts stores, and they gave them 600,000 shares of the company stock valued at $18 million, and also a cash consideration of $13 million. Let's go back to the income statement. Below revenue is cost of revenue. These are all the expenses directly tied to generating the revenue, $1.2 billion. Cost of revenue went up 7%. Revenue went up 9%. So that means their gross profit improved. Gross profit went up 11%. Gross profit is revenue minus cost of revenue. So their gross margin is up from 37.5% to 38.3%. That was driven by improved shrink management and continued promotional optimization efforts. When you hear the word shrink, that's a loss of inventory or cash from customers stealing, maybe employees stealing, or employees making mistakes. Below gross profit is SG&A, $539 million. SG&A is up 11%, so it's now nearly 29% of their revenue. The increase was due to the opening of new stores, also due to higher payroll during the holidays. Below that is depreciation and amortization, $32 million. That is down 5%. It's currently 1.7% of their revenue. Their depreciation and amortization is for buildings, leasehold improvements, and equipment for new stores and remodeled stores. Below that is a $2 million expense for store closures. Let's see what they say about that. Store closure expense was $28 million, now it's only $2 million, so that went down a lot. It went down 93%. A bulk of that $28 million was $27.8 million of impairment losses related to the write-down of leasehold improvements and right-of-use assets. That was in connection to the closing of underperforming stores in 2023. That's what we talked about earlier, all the stores they closed in 2023. So their operating income is up a lot. It's $148 million. It was $101 million last year. Interest expense, $800,000. They give a nice breakdown of interest expense. $2.2 million is the interest on long-term debt. That's down a lot from last year. Interest on finance leases. But they had a gain of $1.8 million on interest income because they earn money on the cash in their bank, because they invest that cash in corporate bonds or commercial paper. Then below is their income tax, $33 million. They show us the breakdown of their effective tax rate. It's 23%. 21% is the federal rate, 5% state, and then they get some deductions. When they pay employees with stock, they get a nice 3% haircut. So net income for the quarter, $114 million, up from $76 million. They're buying back stock. It was $104 million, now it's $101 million. Earnings per share, $1.12. I just noticed this right below the income statement. They show the stores open and closed and acquired. This is for the quarters we're talking about. Comparable store sales growth, 4%. So when you compare the same stores that were open last year as open this year, revenue grew 4%. Last year it was 3.1%. That's not even beating inflation. It'd be nice if it was higher. Stores at the beginning of the period, 407, they didn't close any in the first quarter. Last year they closed 1 in the first quarter. They opened 7. They didn't acquire any. They acquired 2. We talked about that earlier. Let's look at a statement of cash flows. The first section is operating cash flow, $220 million of operating cash flow. Last year, $180 million. So that's up nicely. It looks like the main reason was higher net income. The other numbers look pretty similar when you compare both time periods. They mentioned the increase in cash flows from operating activities was from favorable working capital, $30 million, and higher net income, $16 million. In their investing section, they spent $51 million of PP&E, $47 million last year. Last year, they spent $13 million when they acquired those 2 stores. They expect CapEx to be in the range of $225 million to $245 million for 2024. That's due to investments in new stores, remodels, maintenance CapEx, and corporate CapEx. And they plan to fund their CapEx with cash on hand. So that's good. They don't need to take on any debt to fund the CapEx. In their financing section, they repurchased $60 million of stock. Last year, $98 million. and they received $2.3 million from the exercise of stock options. And they mentioned the same thing in this blurb down here. Financing cash flow was mainly from stock buybacks, offset by $5.5 million in proceeds from the exercise of stock options. Let's look at a company on Simply Wall Street. It's last priced 84, 8.4 billion market cap, up 8% in the past week. Look at this, up 128% in the past year. They IPO'd back in 2013 at $38. And then after 3 months, it was up a decent amount, almost 50 bucks. And then for the next 11 years, it did nothing. All it did was go down and down and down and down and down. Its low point was 15, so it never got that low, but it didn't really increase much since IPO, until recently. The stock has done phenomenal in the past year. 1 year ago it was 36, now it's over 80. If you did buy the stock at IPO, that's a long and painful ride. Simply Wall Street's valuation is 49. They say the stock is 72% overvalued. 10 analysts priced this stock at 70. Their revenue forecast for this year is 7.4 billion, next year 8.1 billion, then 8.9 billion. Free cash flow forecast for this year is 260 million, next year 249 million, then 266 million. My free cash flow forecast in my model was more aggressive than this, because if I use these numbers, then the stock should be about 50 bucks. And I don't think it's going to go back down to 50 this year. The red line is their debt, the blue line is their equity. So they were similar in 2019, but they've been splitting apart recently. And the green line is their cash. They have more cash than debt. The CEO's salary was $550,000 in 2019. Now it's $1.2 million. Total compensation, $9.5 million. Tenure as CEO, 5 years. The San Francisco-based BlackRock is the biggest shareholder at 12%. Then Fidelity, 11.8%. That stands for Fidelity Management and Research. Then Vanguard, State Street. Goldman Sachs owns 2%. Morgan Stanley, 1.19%. Schwab, 1%. And their employee count has gone up a lot, from 14,000 to 32,000. That's because they've been adding more stores. The ticker trades on the Nasdaq, Deutsche Börse, and Sao Paulo Bolsa. Let's go through the history of the company. In 1969, the Boney family had a beloved community grocery store. They renamed that store Henry's Farmers Market in 1997 after their father. Other members of the Boney family opened a Sprouts Farmers Market in 2002 in Chandler, Arizona. In 2011, the Apollo Global Management Company combined 3 companies together: Henry's, Sprouts, and Sun Harvest. They merged those 3 stores together and called them Sprouts. Sprouts became a public company in 2013. Fortune magazine included Sprouts on its list of the world's most admired companies in 2018 and 2019. As of today, there are 413 stores across 23 states. They offer products that are minimally processed and free of artificial flavors, food coloring, preservatives, and synthetic ingredients. The company says that 90% of its products meet this standard. They do have their own private label brand with more than 2,400 items. Every store's vitamins and supplements department includes about 7,500 products. Produce makes up about a quarter of the business. Most stores have about 200 types of organic produce. They have stores in Alabama, Arizona, California, Colorado, Delaware, Florida, Georgia, Kansas, Louisiana, Maryland, Missouri, Nevada, New Jersey, New Mexico, North Carolina, Oklahoma, Pennsylvania, South Carolina, Tennessee, Texas, Utah, Virginia, and Washington. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.